All right, Tom, I think we are ready to kick things off. Can you hear me okay?
I can.
Had a few minutes for people to see Wally up on screen here. So let's get started then. Welcome everyone. Casey Snyder and Tom Sedoric here, and we thank you for making time for this afternoon's semi-annual market outlook. And due to popular demand and permissions from our compliance department, we will continue with our webinar format to provide the ability for those who are more visual to follow along with us. All right, so this afternoon, we will break our content up into three different sections. First, we're going to look back. Second, we are going to look ahead using history as a guide and knowing that no one has a crystal ball. And then lastly, we'll conclude with some important themes as we plan for the future. Now, throughout this webinar, there is a chat box to submit questions as they come up. Rather than pause as we go along, we will compile those questions at the end and do our best to address any that come in. And then lastly, assuming that we stay within the boundaries of compliance and compliance signs off on this webinar will be available for replay. And when it is, we will send it out for everyone to be able to digest and share at their leisure. Tom, would you like to say a quick hello?
Greetings, everybody. Thanks for joining us.
So, Tom, with that, let's begin here. We start by looking back. All right. And we begin in the US equity space. All right. And so far, 2024 somewhat looks eerily similar to 2023, with the Magnificent Seven dominating returns, momentum being on a tear, meaning that tech and AI narrative continues to prop up or propel markets somewhat to a scale that's never been seen before, even recently passing that of the dot-com bubble in 2000. Now, rallies like these are rare, and what was once upon a time the exclusive trillion-dollar club is becoming a bit less exclusive. Tom, before I ask you a question here, just want to give the audience here a quick definition or review of what this is. What we're showing here is the Magnificent Seven in terms of its year-to-date performance versus the other 493 companies, which are positive, but as of the end of June, we're only up 5 relative to the dramatic performance of the Magnificent Seven. And then over here on the right, what you can see is that the top 10 stocks in the S&P represent a significant concentration. So, Tom, would you mind sharing some of your experiences when it comes to dynamic or unusual market rallies like this?
I think it's cute that I always get called upon to provide the historical perspective. I should have said hysterical as well, but historical perspective because I do remember some of these other bubbles, most notably, and even though it was 24 years ago, the dot-com bubble, which is eerily similar to what we're seeing today. It was different, but it does rhyme, and I think therefore we're being very cautious. But it doesn't hurt to bring it out and show this differential. The markets are broader. The rally is broadening out away from the Magnificent Seven to some extent, but it's still very concentrated.
Tom, what about, I think about the last 40 years, and we talk about concentrations quite a bit here. There was a pretty significant concentration or dynamic rally in the 80s overseas. Can you share a little bit about that one? Because that's historical.
Yeah, it was Japan, and I remember it vividly because my father's company was a licensee of one of the biggest Japanese company, and actually still is, Mitsubishi. And my father, who was a genius IQ, who just kind of was in awe of what was going on in Japan. You might recall it was a post-World War II recovery, dramatic one, but their markets were on fire for the better part of 15, 20 years, and their economy was on fire as a result. Ironically, that ended too, and of course, I think many of you have seen it in the media where it is only recently that the Japanese markets have recovered to those levels that they reached back in the 1980s.
Yeah, that was pretty dramatic. And then, Tom, one other aspect here is, what we've seen over the last couple of weeks, to your point, about how the rally is starting to broaden some. We're seeing a rotation out of some of these tech names into other areas of the market, even people leaving the S&P index position, thinking that the index doesn't represent the market as a whole anymore. So
Yeah, even the noted writer I'm sorry, not Jeremy Grantham, Jonathan Clemens, who has a blog. He was at the Wall Street Journal for years and years. He has a humble dollar blog, and even he, who is a rabid indexer, is talking about people broadening their holdings away from just the S&P 500 index.
right. Well, so Tom, I want to move away from stock markets into the subject matter of inflation. When we look back again on the last 6 to 12 months, it's a variable that comes up all the time. And inflation's normalizing, but it's down from its high of 9%, but many people don't see it that way. And for many, it doesn't feel like it. So Tom, what's the misconception here, and maybe provide some examples?
Yeah, well, there are a couple of things I think need to be addressed. One is the term recency bias, which you've heard us talk about in the past, which is a very profound behavioral response. We had a fairly extended period of really, really low inflation, to a point where it's never occurred this way in history before. So all of a sudden, when inflation pops up, and you have inflation, an increase in inflation, as you're outlining with your cursor, Casey, you feel it more because you haven't had it for so long. Now, just a reminder that disinflation and deflation are two different things. Disinflation relates to the pace of inflation, and disinflation is actually occurring. So we're seeing the rate of inflation increase at a slower pace, but we're not seeing deflation. Deflation is when prices actually drop, and that did occur previously, but it has not yet to happen now.
Well said. Yeah, it doesn't mean that things are getting less expensive. They're just rising at a slower rate. Tom, continuing along those same lines, and this relates to the theme of inflation. And even though inflation's normalizing, it's taken longer than the Fed would have preferred. Thus, rates have been higher for longer. And this was something that we cautioned during last year's mid-year outlook. We spoke to it a bit again at the end of last year and early this year. As of right now, short-term rates are expected to begin falling maybe as early as September, but longer-term rates appear undecided about their direction right now. So, Tom, can you speak or provide some context and elaborate a little bit more on the bond market this year versus what pundits projected in late 2023?
Yeah, that's right, Casey. The pundits were projecting that rates were going to drop, the Fed was going to start easing, and of course, that didn't happen. I think it's also very important for our listeners and viewers to remember that the Federal Reserve Bank only controls short-term interest rates. So to your point about the longer-term bond market's undecided, could be said more accurately because the Fed doesn't control long-term interest rates. It only controls maturities less than a year. So when it raises or drops rates, it doesn't necessarily influence long-term interest rates.
Right. And there's a lot of speculation about what inflation may look like a year from now, 2 years from now, as we get closer to this election. We'll come back around to that shortly here. There's one more, I think, piece of this puzzle that we want to showcase here today. That, with the return of inflation over the course of the last couple of years, it's common for many people to share their 1970s experiences with higher interest rates, inflation being what it was. And some will speculate about there being a return of that sort of environment. But in many respects, and that's what this chart is meant to depict, we may have already lived through an event very similar to that of the 70s. So if we're looking at this chart here, the blue line is meant to represent nominal yields. These are yields before taking into account inflation, versus the gray line, which are real yields. So real yields are yields after net of inflation. And in the world of investment, all that matters is real yields. And the example being, I'd rather have a 6% inflation rate with a 9% yield. That's 3% real real returns versus a 2% inflation rate with a 2% yield, which equates to a 0% real return. But what you can see here in this chart is from 1969, essentially, to 1981, we had a pretty unusual stretch here of negative real returns, dramatic spikes up and down. It was uncomfortable. If you look at from 2011 to 2023, it's awfully similar. Maybe the drops aren't as dramatic, but we're looking at a 12, 13-year stretch here of unusually low, often negative real returns. So we share this because we're not quite sure people appreciate the magnitude of what's occurred over the last 12 to 13 years. Tom, you already touched on it. Inflation was running very low for a prolonged period of time, but so too were interest rates. So we've lived through a historical event. Real yields appear to be back, and that's a very exciting component of returns as we plan for the future. Anything you want to touch on that, Tom?
Casey, it's what you make after inflation, and quite frankly, we'll touch on it later, after taxes, that really matters.
Bingo. So, all right. So that's going to conclude our brief sort of look back. Now we're going to look ahead. And we're going to focus on two categories here, equities and bonds. And this is a chart that I believe everyone on this call will have seen before. It is updated monthly. All right. And it's meant to reflect valuations relative to their mean. So whether markets be above the mean, below the mean, you hear us talk about mean regression, which is that markets over time revert back to their mean. And we thought about including this chart in the look back segment, but decided to use it looking forward because of how extreme distortions don't have a history of lasting forever. And we think it's really important that people recalibrate their expectations based on this. So what we can see here in the upper right-hand corner is how outside of the norm we are today. At the end of 2021, we were pushing a 4 standard deviation event as a result of some of the recovery over the course of the last year and a half. We're back up closing in on that 4 standard deviation line again. So Tom, having said that, this chart may not be a true representation of the US stock market. So can you shed a little light on that?
Well, you talked earlier, Casey, about the Magnificent Seven and how it's distorting markets. So this is the S&P 500, which is a commonly used index of domestic stocks. And we're going to touch on the foreign markets in a little bit, I know. But you can see how extreme return, how generous extreme returns are, but in terms of valuation, also how excessively rich they are. The only time even close to it was what we talked about at the beginning of this call, 2000, right? Look at what happened then. And then following that period and that bubble that popped in 2000, we had basically a decade of flat returns. And we think that likely it could happen again, and hence the need for diversification. Because if you stay away from just the Magnificent Seven and focus on other holdings, things that pay dividends or overseas, you'll probably weather it very well, just like we did after the dot-com bubble.
Yeah, and we're not, to your point, Tom, and what we just talked about, the concentration may be distorting this page significantly. And even over the course of the last week and a half, we saw small caps, an area of the stock market that's not priced anywhere near this sort of extreme valuation, have one of its best 5-day stretches since 1986. But that's because it's been left out of some of this rally over the course of the last year and a half. And the same could be said for some of those dividend payers, Tom, that you just mentioned. And we will say that this chart is also indicative of there are areas of people's portfolios that have performed really well that we may be looking to scale back a little bit, similar to what we did in 2021 as it relates to what we call risk creep, where the risk increases as a result of performance over time. So, Tom,
I'll go back to that metaphor at the beginning of this call, Casey. We had Wally up. I also bring up the Lost in Space show that many of us remember from the 70s and 80s. Danger, Will Robinson, Danger, Will Robinson. We're not running for the hills, but we're certainly voicing caution here.
Well said. And I like that robotic move you got there. You touched on dividend payers. You mentioned dividend payers. I mentioned dividend payers. We love dividend payers because, well, for a variety of reasons, but we do want to comment here that this is not your father or mother's dividend market, that suddenly tech companies are accounting for 14.1% of total cash dividends paid by S&P 500 companies, making them the second largest contributor in dollar terms. Their percentage yields are still relatively low because of the high price of many of these companies, but in absolute terms, in real dollars, they're huge dividend payers. And going forward, Tom, you just mentioned it, I referenced it, this broadening market could create an opportunity for dividend-oriented strategies that may be relatively cheap, while also creating that compounding effect. And Tom, if what this chart shows is kind of the evolution of dividend payers. So can you comment about what you've seen throughout your career as it relates to the evolving dividend payers within the market?
Absolutely, because the dividend payers, when I began my career in the early 80s, were the chemical stocks, the financial stocks, the banks, utilities have always been known for this. And the leadership of dividend payers is changing markedly. And you just noted in this chart, Casey, the two top dividend payers are technology companies, not energy and not finance. Now, today, technology is a big component of the payment of dividends to shareholders, as is real estate investment trusts, telecommunication stocks, and healthcare companies as well. They're all contributing to the dividend payout ratios going up.
Yeah, and I think we're going to come back to this in a minute, Tom, but the other aspect of dividend payers is that they can help investors make progress towards their goals when markets move in a horizontal manner or go down. So it doesn't have to be a lost downturn if you're compounding shares or collecting your dividends to live off of. So dividend payers are a really important component of almost everyone's portfolio, just to different degrees. Now, continuing to look ahead, we almost left this slide out of fear of sounding like a broken record, but the data is too compelling. So this chart here gives a sense of overseas markets relative to US markets. And the title speaks to it in terms of the potential for compounding looks right. It's a busy page. We understand that. The takeaway from this page, though, is if we look at the chart on the left-hand side, the lower this gray line goes, the cheaper non-US equities are relative to the US stock market. And you can see this trend is still continuing in that downward fashion here. On the right-hand side of the page, the higher this gray line goes, the higher the dividend yields are relative to US equities. So the combination of these two, where you have low valuations paired with higher dividend payers, makes for a very intriguing, attractive combination. And I think back to time we talked about the 70s here just a minute ago, in terms of that being a rough decade for real returns. We sent an email update a couple weeks ago about the importance of or a couple months ago, 2 months ago, about the importance of compounding. And if somebody were to have compounded dividends throughout the 1970s here in the US, the 1980s and 1990s, there was incredible wealth created, but it takes discipline. It's very hard to do for long periods of time, but it's powerful, and it's why it's called the eighth wonder of the world.
And it's worth noting that the chart's so graphic, it's easy to see it, that when we looked at domestic equities being 4 standard deviations away from the norm, look at foreign stocks being 3.5 or almost, 3.5 standard deviations away from the norm. In other words, cheaper. So we're not saying sell all your domestic stocks and put it all overseas. We'd never do that, but it was the thing that saved us in the early 2000s, was having broad global diversity with high dividend payout ratios.
All right, and continuing along those same lines, this is an example of be careful not to judge a book by its cover, because the US has dominated returns to some extent, but it doesn't mean that there aren't great companies overseas. And we also wrote about this a couple months ago. We emailed everyone some content about it. But, here's a list of a handful of names that have even outperformed that of the Magnificent Seven since 2022. So, it's really less about where a company may be domiciled and far more about where their revenue comes from, their consumer base. And Tom, maybe you can speak to how markets or investments have evolved over the last 2 or 3 decades in terms of people's approach to this non-US, US sort of comparison.
Yeah, I think well, our clients, because of, I guess, part of my foreign upbringing was helpful in this regard. All of our clients have had some degree of foreign exposure all along. So that's been beneficial, as I said, after the dot-com bubble. But I think it's really important to understand how we cannot invest looking in the rearview mirror. We've taken on a number of portfolios for clients, particularly an older set. In many cases, you'll see a portfolio that suffers from benign neglect. They have all the big names of the 1960s and 70s that are now faded stars, and none of the exposure of any of the companies that you show in the upper part of this chart. And our job is, if we're going to be diversified and risk managers, that we have to broaden out their exposure to areas they may not have had before.
Well said. And I think that, I think the last point I'd like to make here on this page is that the Magnificent Seven represents a very concentrated sector. It's tech, it's AI. And when you look at some of these names that have led overseas, they represent a more broad cross-section of an economy. Whether that's good or bad, we don't know. You don't know without the benefit of hindsight, but it may be more reflective to the broader markets versus here in the US, where we see that unique concentration. Tom, let's move away from equity markets, still looking ahead, but we're going to now move into the exciting subject matter of the bond market, which can be a little confusing. So we're going to try to summarize this. Forecasting returns in the bond market is a different animal than trying to forecast returns in the equity markets. And in many respects, it's a bit easier because when you buy a bond that's going to pay 4 or 5%, you kind of have a sense of what you're likely to make, as long as you hold that bond through to maturity. So what these charts here reflect is how starting yields, starting interest rates have moved over time to where they are today. If you look in the upper right-hand corner of both of these, we're looking at very attractive starting yields when you think about future returns. And if you look at the bottom here, you can see how unattractive these starting yields were just a few years ago. And Tom, you already mentioned this concept of recency bias. People tend to run from areas of the market that may not have performed very well of recent. Can you speak to recency bias as it relates to the bond market, given what we've just experienced and where we are today?
Yeah, absolutely. And Casey, you referenced it earlier about the dramatic change in the bond market, where many investors are not aware of what happened a year or so ago, where rates moved up so dramatically. But it is a much more attractive bond market today than it was 5 or 6 or 7 years ago when rates were pegged at zero. In fact, it was downright scary when rates were pegged at zero. And today we see much more attractive yields, much more attractive entry points for fixed income investors. And we just trying to, if you come away from this call with two things, is that we want to have some degree of foreign exposure because the potential there. The other is that we want you to have bond exposure, and our clients do have it, but the general public may not, and we think that's important. If you want to talk to your friends, ask them about their bond portfolio. They'll probably glaze over, but ask them anyway.
Yeah, it's not the most thrilling dinner time conversation, but hey, if you can generate 4, 5, 6, 7% yields, it does get exciting given what we're used to over the last couple of years. And I just want to comment real quick on this, is that the bond market just endured what was essentially almost a tech bubble-like crisis. 2021, 2022 into 2023 was a really ugly stretch for the bond market. If that had been the stock market, people would be terrified from equity markets, but everybody knows it's time to buy into an equity market when it's cheap. The bond market operates a little bit differently than that, but again, you can see starting yields really attractive relative to what we've seen over the last 14, 15 years. And here's an example of some of this risk reward, the risk return profile when it comes to the bond market. And this is an example using interest rates from back in May. Because what happened in 2022, we saw the downside of the risk profile where interest rates rose dramatically and we saw bond valuations come down in historic fashion. But now with interest rates at their starting point being much higher, this gives you a sense of, hey, if interest rates were to increase from here by 1% or 100 basis points, you can see here kind of the estimated impact that it would have on different types of bonds or different maturities. It would have a minimal impact on the 2-year, the 5-year, even the 10-year, more of an impact on the 30-year bond to the downside. But the difference is, look at what happens if interest rates were to decrease by 1% or 100 basis points. You're looking at 6, 7, 8, 9, 12, even maybe 21% returns. So the risk reward dynamic of this bond market has changed dramatically from where it was 2 or 3 years ago. And going back to the slide prior, it gives you a sense of the attractive nature of it as we plan for the future. And it's a big deal when it comes to income streams, people living off of the income streams and wanting to generate that positive real return on the conservative sleeve of their portfolio.
And many of you on this call probably remember some of the activity that we took advantage of. And I give Casey the credit for this because we didn't have the scale and scope ability 15, 20 years ago to do some of the swaps that we executed for many of you in 2020, 2021, to take advantage of the volatility of the bond market. It's all paid off very handsomely for many of you, and Casey deserves credit for that.
Thanks, Tom. So we're gonna move into this last slide here within our looking ahead section, and this tries to summarize basically everything that we just discussed. And what this is, this page reflects a set of capital market assumptions. We call it a guide for the future. And capital market assumptions essentially are a forecast into the future, and these are published by Vanguard. And this is Vanguard's forecast so that 10 years from now, we're looking back, and this is what they believe investors can expect within different areas of the marketplace. So US, non-US, down the line here. And the takeaway from this is you can see that Vanguard's expectation or forecast is that US equities are going to deliver a well below average return compared to its history, thinking about the average as being that 7 to 9% range. If you look overseas, they're forecasting a much higher return, more in alignment with the historical average. And if you look at this category, US growth, which takes into account some of those Magnificent Seven and the AI narrative and the tech boom or craze, what they're forecasting here is a much lower, well below average return. It's hard for a lot of investors to envision this. Hey, I'm going to ditch the AI narrative and some of the positions that have been performing very well. Again, it's hard for people to envision this changing. The second theme here is they'll look over at the bond market on the right-hand side of the page, and you can see that the projected range of returns are very much in alignment with their historical averages. Now, 4 to 6, 4 to 7, almost 8. If you look at some of these, some of the higher risk areas of the bond market, they're attractively priced. And if you compare the two, what Vanguard is forecasting is that the bond market may actually deliver a higher rate of return than the US stock market over the next 10 years. That is also a very difficult concept. I think a lot of people can understand that conceptually. Yeah. But when it comes to portfolios, people are still under the assumption that those equity sleeves and those equity positions are going to generate some of these really high returns. And that may not be the case. So want to caution, there's the folly in forecasting. Nobody has a crystal ball. That's why we appreciate the range that Vanguard puts out and viewing it as more of a guide. So, Tom, anything to add to that?
No, I think it's just important. We've talked about CMAs or capital market assumptions for years. Vanguard does a very nice job consolidating a lot of data together in this very neat presentation. So everybody's got a capital market assumption, whether it be their specialty in domestic stocks or foreign stocks or whatever. But we appreciate Vanguard's efforts to bring it all together in one concise fashion like this.
Um, all right, Tom, that brings us to the end of our looking ahead and into our key themes as we plan for the future. And the first one is this reminder of risk. And we've already talked about recency bias twice. This chart here is that reminder. It's the reminder that markets do go south. They do go horizontal for periods of time. And the real risk is that those periods of time sometimes work against our own timelines, which can be really frustrating. All right. So we know that returns will slow at some point. We just don't know when. And Tom, maybe speak to, during those downturns or horizontal markets, what are some of the things that people can do to help still make progress during those stretches?
Well, you talked about it, and we've kind of beat the horse, but I'll beat it one more time. The importance of dividends in flat or down markets cannot be understated. Dividends saved us, dividend payers and foreign holdings saved us after the dot-com bubble. Our business grew dramatically because of that discipline. So, and not investing in the rearview mirror. Don't chase returns. Look for opportunities in areas that you may not have thought about. We just talked extensively about the opportunities in the bond market. We talked about the opportunities in dividend pairs. We see opportunities overseas. So don't chase things by looking in the rearview mirror once again.
Yeah, and I know we can't speak to our own client base for compliance reasons, but if you look at one of those quilt charts that shows all the different asset classes in foreign versus US, if you look at a balanced and diversified portfolio from 2000 to 2010, it actually wasn't a bad decade. But if you were all concentrated here in the US, it was rough. So, Tom, to your point, that diversification factor remains a really key ingredient. There's another ingredient that we didn't touch on, though, that is probably equally as important, if not more, which is our timelines. We think about down markets or horizontal markets. A really important line item here to overcome those stretches is having an appropriate timeline. This is why we pay so much attention to people's risk profile, the timeline of their various goals, when they may need to start drawing from their portfolios or which accounts. And this is a big deal for us. So, Tom, maybe speak a little bit to what you've seen. I think there's this misconception that retirement is the goal, when retirement is often just the beginning of another long chapter. So I think it's important to frame timelines appropriately.
Yeah, and it's a reminder again, this is a chart that looks at the S&P 500, which is obviously the mother of all indices, but it is largely domestic holdings. I would guess, and I haven't seen the data, but I would guess that if you looked at a broad global index, that the payback period or the win, come even period would be less than the 12 years that happened for the S&P 500. In other words, it might be 3 or 4 years by being globally diversified, which is why we are.
Mm-hmm. Yeah, and this only goes back to 1950, so this isn't full history of it, but the message is the same. Ultimately, the longer the timeline, the higher your probability for success here. All right, Tom, let's move this into the election portion of today's conversation. We are going to remain apolitical as it relates to this discussion, but there's no way that we can't discuss investing during an election year, given all that's going on this year. And really, it is normal. I think the title says it all. It is normal to be a bit anxious. And this year is certainly no exception. Current economic and political challenges may seem unprecedented at the time, but if you look at past election cycles, you can see that controversy and uncertainty have surrounded every campaign. That's not to say that this isn't different. They're all different. But the takeaway from a financial perspective here is that markets and capitalism have been very resilient over time, regardless of the outcome of the election. And coming back to the prior slide, Tom, the idea here is time. Successful investors stay the course and rely on time in the market versus trying to time these things. Now, I want to be clear here. That doesn't mean that we are ignoring a lot of what's going on surrounding the election, especially pertaining Congress. So, Tom, why don't you share a little bit about, especially two things that we are keeping a very close eye on as it relates to potential policy changes and inflation?
Yeah, I think the biggest policy issue that we stay attended to is that relating to tax policy, because taxes, as I mentioned earlier, net of inflation, net of taxes is where your real return occurs. So taxes are likely to go up, which we think is probably going to be the case regardless of who wins the White House. It's probably more important to determine what happens with the tone of Congress going forward and what's going to happen with tax policy. Neither party has shown a great deal of fiscal discipline, as you probably all know. So regardless of your political leanings, it's not a partisan issue any longer. We think it is highly likely that tax rates are going to go up. And that's why we continue to beat the drum about tax efficiency, both in your accumulation strategy, but in your distribution strategy. And we're very attentive to what is happening. You've seen what's happened the last 4 years with what's called the Secure Act, Secure Act 1 and Secure Act 2, how that changes the taxation of distributions from deferred accounts and estate planning. These conversations are going to be increasingly important for our clients and for us.
And Tom, before we kind of wrap up with some commentary or some context surrounding our thoughts on tax policy, just want to add one aspect here, one thing to this, that we are watching for the return of inflation based on what you just mentioned, Tom, that neither candidate seems to show any sort of fiscal prudence or responsibility here as we think about the future and the deficits that continue to accumulate and the spending that may continue to occur. So we just talked about how inflation is normalizing, higher rates for longer. It wouldn't surprise us, given what we see right now, if inflation were to remain higher than what people might ideally expect or wish for when we think about the next couple of years. And Tom, that brings us into the last two slides here, and it's really all about the importance of tax efficiency, which you just touched on. And we're showing this slide to provide some context surrounding the numbers behind our concerns about rising taxes. So on the left-hand side of this page, it shows that the U.S. is currently borrowing around 28% of its annual budget. And then over here, you can see the carrying costs, the interest payments associated with the debt that continues to accumulate. Now, 5 or 6 years ago, the percentage was more like 4, 5, 6% of the annual budget. And now with these rising rates and increased debt totals, we're looking at closer to that 13% and rising. So this is concerning. And when you look over in the upper right-hand corner, you can see the federal deficit as a percentage of GDP. Whether or not the Trump tax bill is extended, you can see the deficit is expected to rise. It's just a matter of how quickly. And so to what Tom just mentioned in terms of some of the policy that we're watching, as of right now, the Trump tax cuts slated to sunset at the end of 2025. Depending on the outcome of this election, that may not occur, and we could see that deficit increase at a faster pace, potentially. And then lastly, in the bottom right-hand corner here, federal debt as a percentage of GDP, you can see that these lines are both moving in an upward trend. It's just a matter of how quickly. So the bottom line here is that the rate of borrowing, the higher cost of borrowing, all equates to the likelihood of higher taxes eventually. Tom, anything you want to add to that before we flip into this last page?
No, just that we've been planning around taxes for the better part of my entire career. I've talked about not having all the money in deferred accounts 35 years ago. We're now seeing it come around. Little did I know, when I was cautioning about tax policy 35 years ago, what would happen. But we're seeing it in full force. And now a good part of our day is spent talking to our clients' accountants about the most efficient distribution and accumulation strategies for them.
Yeah, that's exactly right. And that's why we're going to wrap up here on this page, which is, planning for higher taxes or creating tax efficiency is not something that happens overnight. You can't just flip the switch and say, hey, now I'm going to start focusing on that today. And so this page reflects some of the tools, some of the strategies, some of the things that we have been engaged in, that we have been doing on your behalf now for many years. It's just becoming more noticeable. People are talking about it more frequently now. And so we broke this up into 3 different categories, but there's tax efficiency that's created by way of the portfolio management piece of the financial planning process, whether it be active ETFs versus traditional mutual funds. Asset location, that's the idea of where you locate a specific type of investment so that it's not taxed at the highest rate when you go to draw it out. We've incorporated some more customizable or dynamic strategies for those in your upper echelon tax brackets. And then last year, we spent a good portion of last year kind of hyper fixated on what's more beneficial for someone to own, whether it be tax exempt strategies or taxable bond strategies. And that all comes down to the individual and their respective tax exposure. And Tom, to your point, that's why we're engaged in all these conversations with people's accountants. And then we move into tax and estate planning strategies. Really important. We're spending a lot of time helping folks assess their savings strategy or their distribution strategy. And this is something that we review annually. Roth conversions, we're coming up on Roth conversion season here in the fall. Every year kicks off around September, concludes in December. It's been an increasingly important component of our process. Slats, I won't go into the details here, but the idea here is this is a strategy to help those that are subject to the exemption limits minimize some of their family's tax exposure. And while the exemption limits today are around 13 million? We're 13 million each. Yep. That could very well come down to the $5 to $7 million range, pending the outcome of this election and the sunset of the Trump tax bill. Something we're keeping a very close eye on. And then Tom and I already mentioned the ongoing collaboration with, accountants and attorneys. And then there's a lot of other line items having to do with charitable planning, but these are certainly the 2 big ones in terms of helping folks accomplish their charitable goals through donor advised funds or qualified charitable distributions. And something we talk about all the time, Tom, a rate of return is only as good as its net return, meaning its after-tax return. So again, these are things that we've been working on all along, but the public and others seem to be more interested in them now, and we are equipped to help you and your family as it relates to what's to come here. So, Tom, anything you'd like to chime in on that?
No, just the we're talking inside baseball, but of course, as Casey just said, this is becoming more mainstream in discussions. People are realizing that tax policy really does affect them in a big way. The term inside baseball is tax alpha. It's how to make sure that we optimize returns net of taxes.
Yeah. But Tom, that brings us to our summary here. In trying to summarize our looking back, looking ahead, and key themes, looking back, it's really the AI story continues. Inflation is falling. Rates do or have remained higher for longer, though. And over the last week or so, the market is starting to broaden some. When we look ahead, the idea is that diversification remains a critical component of long-term success. The bond market appears poised with some attractive starting points and may generate some higher returns than people may realize. And then lastly, these key themes here as we plan for the future. Down markets are a normal part of the market cycle, and they are overcome by way of that long timeline, the long-term approach, dividend payers, compounding. When we think about the election, tune out the noise, all right? When you've had enough TV, turn it off, okay? And remain focused on the variables that you do have control over. And then lastly, as it relates to some of that tax-related concern, we do have the experience and the resources to help you and your family achieve that greater tax efficiency over time. And in turn, that also often helps the community as well. So bottom line here, stay informed, remain balanced, focus on those variables that you have control over. And then our next steps here would be to, we ask, and we know everyone's very busy, but digest our monthly updates when you have time to do so. If you have any questions as it relates to what we discussed today that's not in the chat, I'll open that up in just a second. But we always welcome an opportunity to spend some time with you, and are happy to schedule some time. And then lastly, we ask that you share your knowledge and any of our communications, with people that you feel may benefit. So Tom, I'll pass the mic over to you as I open up the question sleeve to see if we have anything.
Great. Thanks again, Casey, and thank you all for attending. We're going to try and queue up and if there's any Q&A. It's a little different format today because it comes in through a text box, as you know. But I think it's important to give you a practice update as well. We've been trying to message this repeatedly over the last few months, probably over the last year and a half, about the transition in the Sedoric group. As we've announced a number of times now, we are going to be rebranding away from my last name. It served me very well for now 70 years, served the practice well for 40 years. But in the interest of trying to provide something for the team to look forward to long after I'm gone, we are going to be announcing our new name this fall. It's actually a name that we're quite excited about, I might add. It has a lot of hidden meanings to it. It was actually a name that was helped created by my daughter and my wife on a cross-country trip they were taking. So I'm very excited about that. And as we've announced before, I will be taking a senior role next year, about a year from now. Still available for consultation, high-level discussions, but less involved in the day-to-day as I've been winding my schedule down over the last couple of years anyway. So Casey, what do we have for questions? I love this part.
I don't think we have any questions, Tom. Either that, or I am not using the function properly or the feature properly. But so I don't know if we have any questions.
Or maybe we did such a great job addressing everything that nobody had any. So
no, we do. One just came in. So
so the chat box is working. Good.
Chat box is working. So how do you decide to convert a traditional IRA into a Roth IRA? And it's a great question. It comes up on an annual basis, and it's something that we are looking at throughout the year, every year, depending on one situation. The bottom line here is that we look at where somebody may be tax-wise. What's their current tax bracket exposure today relative to what it projects to be in the future? So simple example of that is if we're projecting a 22% bracket today, and somebody may be in their 60s, they haven't started drawing Social Security yet, they haven't been subject to RMDs yet, which are those required minimum distributions that kick in at the age of 73, it may make sense to voluntarily draw money out at that 22%, pay it, move the money into the Roth today, and then you avoid what may be higher tax rates in the future. So it's an ongoing evaluation. We often are bringing in our clients' tax experts, their CPAs, to run this analysis with us, and so that we can all make an informed and confident decision.
Yeah, and I think it's also worth noting, Casey, that it isn't just for the current taxpayer that we're looking at in discussing Roth conversions. We're often looking to future generations, particularly the next one. So if the kids of our client are in a much higher tax bracket currently, and mom and dad may be leaving a large IRA to them, it might be wise for them to take it out now to avoid having the kids get taxed at a higher rate. That didn't used to be the case prior to the Secure Act. So now it's a much bigger part of our discussions with tax counsel and estate counsel.
Well said.
And by the way, I'm kind of ecstatic that question came up today, because 10 years ago, nobody would ask the question, and it's an important one that we've been focused on for now 35 years.
Well said. All right. Let's see here. What else do we have here? Oh, they're starting to come in here, Tom. All right. Did the Vanguard chart forecast inflation over the next 10 years at just 2 or 3%, or did I misread? I believe it did. So I'm going to run back to that here for just a second. Tom, we've got another question that you can pick up here. Are international stocks new to dividend payments? That's a good one.
It is a great one. Actually, they're not new to dividend payment. They've been paying dividends as long as US companies have. I mentioned earlier that a good part of the total return of the US stock market for much of its history were actually dividends. They accounted for almost half the total return for the better part of our history. The last 30 years, that's not been the case. Dividends have been relatively meager, and much of the total return in the stock market domestically has been appreciation. That's not true when you look at overseas. So dividends overseas have been historically a very important component of total return, and going back as far as those markets exist too.
Well said. And yes, 2 to 3% in terms of forecasted inflation by way of Vanguard's capital market assumptions.
And we hope it's that low.
Yes, we do. All right. I think that may be it here.
Casey, that a boy, you mastered the chat box.
Hey, we figured it out.
And
Well,
we'll see whether compliance allows us to have this entire webinar available to all of you for replay and sharing with those you think would benefit. I think Casey did an exceptional job. He's the primary actor in the background putting this together. I owe him a debt of gratitude because he makes the rest of us look really good.
well, I'm just going to flip through these disclosure pages for the sake of compliance so that we have a higher probability of pushing this through and sending it out to everyone. So thank you, everyone who took some time out of their afternoon to share it with us. We really appreciate it. Again, if you have any questions, we welcome them, and we're always here for you. So thank you.
Thanks. See you soon.